Hello and welcome to the advisory group's webinar for perspectives on markets, economy, and behavior. This is Greg Patterson, CEO of the advisory group, and we look forward to helping provide some context in the current environment that has certainly been unsettling for many people and investors, both in terms of health concerns, the economy, and investment markets. A key element and concept for being a long-term investor in terms of being successful is growing and learning how to feel comfortable in uncomfortable situations like this. So let's get started. The environment such as this, with this level of uncertainty, both the combination in particular of the health concerns and the economic concerns takes an extra toll in terms of people's psyches and the level degree to which people are worried. But just knowing that that's normal in this type of environment can be helpful. The key thing, as always, is that if you and since you have a long-term plan that has considered and expected certain significant events like this along the way, staying focused and disciplined is a key element to achieving those long-term goals. So what's driving the current volatility? We were in the late stage of the economic cycle, so approaching some level of downturn or cooling economically in general anyway. After the longest bull market ever, 11 years of strong markets and a reasonably solid economy. And typically when that happens, investors, broadly speaking, grow a little bit unconscious of the risks that are naturally present but not always visible. So in that kind of scenario, after a long bull market with stock prices being overvalued to some degree over time, even if not dramatically overvalued, that is a perfect scenario for a surprise event like the coronavirus to increase concern and lead to what might otherwise be a normal correction that has now turned into a bear market if you consider the negative 20% stock return level as the bull market definition. So that is essentially what's happened, compounded by the fact just a week or so ago that Saudi Arabia and Russia began an oil price war, which increased concerns about the impact on the economy as well in terms of supply and pricing. And so that confluence of events is a bit of a perfect storm for market nervousness, especially when you combine the fact that there have been relatively slow and ineffective responses to the coronavirus initially by many governments around the world, including in the US, and still an increasing response, but not consistent across different communities that might otherwise have a more effective impact in terms of flattening the curve and of the virus growth, and we'll talk more about that in a moment. Initially, this was considered to be a health concern and a supply side issue where manufacturing of products and components in China as a leading sourcing location for the production of many products around the world would slow things down. Now the growth and concern and number of viruses, as well as the shelter in place and the resultant impact on smaller businesses and larger businesses, is cooling the economy and therefore the stock markets and creating more of a financial challenge as well, rather than just being a supply side issue. So during this time, with that kind of uncertainty, it's normal for markets to make some significant swings, oftentimes overreacting in both directions, trying to find the right level. And of course, as additional information sometimes good information, sometimes bad information comes out, the market will react to that as well. To compound this, for some people who've really been only investing in the last 10 years, if they are as working adults, for example, in their 401k plans or otherwise, this is the first significant market drop. And so that's especially uncomfortable for people of that situation, since they have not been through it before. And this drop has been a little steeper, considerably steeper than usual, and that makes it more concerning in terms of the psyche initially. So I think this is a great quote here from a doctor at Johns Hopkins: "Concerns and anxiety often spread faster than infections." And that's really what is happening now, although the infection factor is significant and important as well. So in terms of where we are in the business cycle, we had been in an expansion that gradually cools, heading towards some sort of contraction, and now the coronavirus and related impact is accelerating the contraction. And the question is, how deep will that be? What level of recession might there be? And that will be dependent upon the reaction of communities and the government. We'll talk more about that. So where do markets stand now? To take the extreme example, a lot of travel companies have had stock prices drop more than 50%, which makes the broad market pale in comparison to that. So that's a testament to diversification. The S&P and the world stock markets, broadly speaking, are down about 34%. If we look as of a couple days ago, yesterday was down a little further. Today, so far, up fairly strongly. So the current numbers are still probably roughly in this range. In the U.S. bond market, down about 2%. Primarily, normally, bond markets would be up in this type of environment, but because of the big issuance of government bonds in an attempt to increase stimulation, that did increase some budget deficit concerns, which has led to some impact on the bond pricing. But still, if you have a combination of stocks and bonds, even a small negative percent creates a significant diversification relative to a larger stock drop in the short run. Now, if we look at different stock bond mixes, here are some examples using the broad global index for both stocks and bonds, or a U.S. bond index and a global stock index, rather. At 25%, 75% bond mix would have only dropped 10% roughly as of that date, just a day or so ago. A 60-40 mix down about 21. So, excuse me. You can see that diversification really has a significant benefit, even if markets have cooled materially, even for stock bond mixes, dramatically better returns than a 100% stock mix. Those that are in a 100% stock mix should really only be those that are much younger along the spectrum and have a whole lot of time to play that out over time. And that can be appropriate for people that are young enough and in the right situation. Taking a look, putting some of this in perspective, looking at other major market drops in the last 100 years or so. You've got everything from the Great Depression to the global financial crisis. You can see here that significant market drops from peak to trough are not uncommon. They happen with some regularity, in fact, if you look at it at this level. This column shows the number of days from the peak to the trough. So that varies significantly as well. And the trough, or the bottom back to the peak, varies significantly, tends to be shorter than the number of days from the top to the bottom, and the gains are significant. So again, a very valuable reminder of how important it is to stick with your strategy if you have the appropriate strategy for your plans and your life stage. And as a good reminder as well, out of all these periods, the average recovery was 26 months. In more recent decades, the average was closer to a year and a half or 17 months. And in half of all the cases, it was less than a year. And in only 1/3 of the cases was it longer than 2 years. So recovery does happen And that's also shown here, a set of more recent significant drops where the drop is shown in red from peak to trough, and then the first year after that, once it hit bottom, shows significant increases. In most cases, a full recovery and then some. In some cases, not a full recovery in that first year, but the full recovery happened over subsequent periods. So not abnormal to have significant drops, and it is normal to also to have significant recoveries for those that are patient and disciplined. 60-40 portfolios, using another example, have bounced back strongly as well. Some overlap in the market examples here, but this chart shows that in almost all cases, significant recovery in the first year, and in all cases, significant recovery in the subsequent years over 3 and 5 year time periods. So whether it's stocks or a blend of stocks and bonds, time is your friend and discipline is your friend in terms of full recovery and wiping out those losses or negative returns. Another way to look at that is to take a peek at the 4 worst markets in the last 100 years. The Great Depression in gray, the .com crash in green, the oil crisis and financial crisis of the 70s in red, and the global financial crisis in blue. And these numbers are after inflation, so it shows what the actual returns are that people were able to essentially keep after the purchasing power losses caused by inflation, which shows that the global financial market had a drop in blue here, and then really an excess recovery relative to other major markets. And then we've drawn in an example of roughly what's happened more recently, a steep drop, but in the magnitude relative to the full recovery, still not erasing a big chunk of the gains of the last 10 years even. We'll show you another chart on that in a moment, but the key point here is that when the market drops, some people in the market panic, and that's actually what causes the price to drop, because the market is essentially an auction, and when it reaches a certain point and realize, hey, wait a minute, the news isn't as bad as we thought, or there's some improvement in the news, and then there's usually an initial snapback and then some level of bumpier recovery. So that panic button is the same button that some people are hitting now, but disciplined investors will benefit from riding that out, whereas those that hit the panic button will miss, in most cases, or a lot of cases, that full recovery eventually. If we take a peek at this histogram going back really far back, all the way back 230 years, you can see the years stacked by return buckets. So you can see that the vast majority of returns over the last 230 years happened between the negative 10% range and the positive 30% range, with a few outliers above and beneath that, including the global financial crisis return in 2008. But one thing that's really important to note is the last 10 or 11 years have had unusually high returns, with the 10-year average annualized return of almost 14%, which is almost twice the projected return of stocks. So returns and markets have essentially overshot, and part of what's happening now is bringing things back to a more normal level. The coronavirus element and the impacts in the economy are taking that a little bit further than just a normal correction, but it's important to remember what the average annualized return numbers are. Another way to look at that more specifically here is if you see this chart and the rise in what this section could be viewed as the excess return relative to the projected returns and a more normal return over time, and this is bringing it more back to a little bit closer to normal. If we take that 11-year bull market and tack on a negative 30% return, the average annualized return over a 12-year period, if it stays at that 30% for the whole year, which is unlikely, would still be an 8.6 average annualized return over 12 years. Even if it dropped 45%, which theoretically is possible, may not be likely, but that would still lead to an average annualized return over 12 years of 7.1%, which is still above the 10-year projected return of 7%. So that may help with some perspective. What the volatility that we're feeling now is definitely uncomfortable, but when you put it in the context of averaging it out over time, it's not quite as bad as it might seem, and that may give you a little bit more confidence for the long run. If we look at averages going back about 100 years, back to 1926, the stock average is about 10%, inflation about 3%. The 10-year projections have been lower than that, partly because we have not yet encountered the next major productivity enhancing industry breakthrough, whereas in the last 100 years we had the Industrial Revolution, the personal computer revolution, and other factors that really dramatically increase productivity. Some would say that artificial intelligence will be the next wave, but it hasn't happened yet, really in a more significant way. So as a result, there's some decreased long-term projection expectations, but still solid and would allow, with appropriate planning, for people to accomplish their goals. Another way to look at this volatility is in the context of other bad markets graphically. So you can see, going back to the Great Depression area, a rise, a fall, a rise, a fall, a big rise, a fall. And that has tended to repeat itself somewhat frequently. And more recently, we've had a longer than average rise, which helped people forget that those drops are actually more normal than they thought. Similarly, or another way to look at that is to see how common it is for a negative return within a given year to end up being a negative return for the entire year. And so what this chart shows is the negative intra-year or within-year return, shown here in red, over the last 30 years or so, and the high point return within that same year, which is oftentimes the bounce back after a negative period, leads to the broader blue bar here of the final year return, which in most cases, despite having significant negatives during the year, ends up being positive. There are several years you can see here that were negative. This year could end up being something somewhat of a negative return as well, but there are oftentimes surprise events and elements that cause markets to respond and recover more quickly than expected. So we'll have to wait and see in terms of what happens there. Let's talk now about the coronavirus and viruses in general, because this is important in terms of the psyche of the investor and the impact on the economy. So as many of you have probably already seen such charts, virus growth that is left unchecked without significant medical advances or significant shelter in place and curve flattening efforts has a steep peak that is more dramatic and that leads to systematic problems in terms of healthcare capacity. That is a bit of a vicious cycle in the sense of the psyche of the economy. People tend to develop more of a bunker mentality, tend to protect their spending, reduce their spending. And if this healthcare system capacity is jeopardized, then there will be more deaths, and that further increases concern and causes people to have a negative reaction, both in terms of spending, which slows down the economy, and in terms of investing, in terms of panic selling. And there, again, it's a bit of a vicious circle. The other scenario is where there's significant social distancing and sheltering in place, which ideally would maintain the number of cases to a point beneath the healthcare system capacity, which would allow for better treatment, more consistent treatment, reducing dramatically the death rate, dramatically reducing levels of concern, and that kind of impact then tends to lead to higher levels of comfort, less concern, more spending, more economic stimulation, less market panic selling, and so forth. So the way that governments and communities approach the virus is really fundamental in terms of the economy, health, safety, and investment markets. Even if the flattening of the curve leads to a longer period of actual total virus exposure, it has less of an impact on lives and markets and the economy. Let's take a look at a specific example that's not identical, of course, and no two cases are the same, but just as a general proxy, the SARS virus event that started in roughly in 2002, roughly at the end of 2002, there were initial cases that gradually ramped up, and then there was initial steepening, backed off a little bit, and then had a kind of a two-peak scenario. The overall shape, though, if you draw a rough line here, is there's an increase, somewhat like that curve we just looked at a moment ago, and then a pretty rapid decrease in cases once it was under control. So we've drawn this two sets of bars here to illustrate the idea of a corner, because the investor in general cannot see around that corner and believes that this line is infinite until news comes out to the contrary. So what you can see is as virus cases ramp up, the stock market trailed off and had increasingly negative returns until there was news and information that would suggest that the corner was visible and that the corner was palpable, and that's when markets started to improve and an accelerated improvement as the actual cases really more consistently dropped off. So the SARS peak happened at about 5 to 6 months. If we consider COVID-10, the coronavirus, which some scientists are actually calling SARS-2 because of some similarities with the coronavirus, the novel coronavirus, if we consider that to have started around November or December, that would mean we're now at the 3 to 4 month mark, and we're not suggesting specifically at all that this will match 5 to 6 months like SARS. Can't predict either way, but the general pattern to notice here is that rise and fall, the impact of the markets, and it's critical to note that China and Washington State have had significant leveling because of social distancing, and if that's done broadly enough, can help reshape this curve for the coronavirus. So this brings us to that pattern of selling is a good reminder to take a peek at what the emotional investing cycle is for some people. So markets, when they're on the rise, leads to optimism. In general, people get a little bit overconfident when markets are strong and investor complacency goes up and concern about risk goes down. Then when the risk starts to happen in the natural business cycle, there's a nervousness. Then a buyer strike, which just means enough buyers stop buying because of their concern that those that need to sell don't have a buyer. And that causes prices to accelerate, further creating a momentum effect where the steepness can increase dramatically. We've seen that in the last week or so as well. And this is where some investors panic and sell. Of course, by definition, that hits a bottom and investors begin to realize good news is coming out. There's reason to be more confident. Maybe the market oversold, and there's oftentimes a rapid snapback. But some of these people who sold low, wait, and missed that full recovery, and that's when the real losses happen. Until then, it's just a paper loss. So the key focus for you is to think about point A versus point B and imagine that whatever happens between here and there are just bumps that if you ignore them, if you have an appropriate strategy for your life stage or necessary strategy of your pool, investment pool, it will get you to where you need to be over time. Now, a lot of this also relates to investor psychology and brain science. So the prefrontal cortex, the big front part of the brain, is the part that makes rational decisions. The brain stem, amygdala, what some people call the lizard brain because it dates back to the reptilian period long before the prefrontal cortex had developed, which is really the fight and flight reflex, which is a very valuable part of the brain, an important response if you are being chased by a lion, because you really do need that fight or flight response. But when that fight or flight response kicks in and it is a response to a financial market, that's when wealth tends to be damaged. On the other hand, those that understand that they can confront that bear market, understanding that it's a psychological phenomenon, that financial markets are not a physical threat, can ride out those bumps and end up having stronger wealth and better outcomes over time. Now, what's a little bit confusing for some people is that the current environment with the virus being something physical seems like increases the perception that there's a physical risk. But the virus is really still, despite the increase in rate, is a low relative physical risk, is not the same as being confronted by a lion where the chance of survival is pretty low. And there are things we can do as a society and in communities and through health advances that can help tamp down and flatten the curve of that virus and make it even less significant. The news doesn't really help either in these types of environments. Always like this, this drawing on the napkin. The more stories there are about the market, the greater the chances you'll make a mistake, especially when the stories have to do with what direction the market is going. It tends to tap into that fight or flight part of the brain that we talked about a moment ago. And there's some covers that we, magazine covers we scanned a long time ago, dug up, and occasionally pull out. Always get a kick out of re-seeing this, where the news, for example, the death of equities in August of '79, essentially encouraging people to panic and get out of the market. And then just a couple of years later, they were talking about the rebirth of equities. There was a 60% increase in the market between those two magazine covers. In the 90s, similarly, the S&P rose 50% in less than 2 years between a period where a magazine, as you can see, said sell stock now, and then it went up 50%. So following the press and their sometimes sensationalized approach to selling subscriptions doesn't always help. There are some news sources are better than others, but they all have the incentive to attract eyeballs because their advertising revenue is their primary driver of their businesses. And so you want to keep that in mind when you are hearing information on the news. So I'm not going to go through all this in detail, but the government in the last week and a half or so has really taken some significant steps to try to be a backstop for the financial markets and the economy through rate cuts, injection of money into the system, and so forth. And it may be that while this webinar is occurring, the $1.6 trillion stimulus package may be finalized, not to be determined, but that was part of what the expectation of that is part of what was causing a very strong day today. But you can see, in other words, a lot of activity the government is doing in terms of the Fed in particular, quite a few tricks it's pulled out of its sleeve to similar in some ways to what they did during the global financial crisis in a creative way to try to help improve the economic system and stimulate improvement. Now, the key thing to note, though, is that this can take some time for those effects to show. That the market will have an initial response one way or the other in combination with other news, but the real effect actually takes some time to drip into the system and actually drive real news and real impact. So it's a bit of a two-stage thing, or a multi-stage thing rather, over time. So be patient. Don't expect this news and these elements to have an immediate, for the full effect to be immediate. There's an initial perception effect, and then there's a gradual actual impact over time. So what's next? There's a lot of talk of different shapes of recoveries: U-shape, W-shape, pan-shape, L-shape. In fact, pan-shaped is something we are coining ourselves now. U-shaped would be a drop, and then similar to a V-shape, where drop and then recovers. W-shape might be, in this scenario, might be the market and economy is cool, and then if summer doesn't tamp out the virus like some warmer seasons do, or and social distancing doesn't have enough of an impact in time, then after summer, theoretically, for example, there could be a bounce back of the virus and then another level of concern about the economy and the market, followed by the end of the W, which would be the more complete recovery. L-shaped would be the steep drop and then going sideways for a while. And one scenario that we're talking about is this pan-shaped, which would be a combination of a couple of them, where there's a steeper drop than usual, some sideways bouncing up and down, potential in a slightly negative trajectory, given the uncertainty in the news and the delay in the financial stimulus packages and so forth, and how that injects itself into the economy over time, followed by an eventual recovery or partial recovery, and then some natural bumpiness towards full recovery. So I think it's fair to say, in listening to experts, that it's going to get worse before it gets better. We just don't know how much worse, both in terms of the virus and the economy and potentially markets. But in particular, the virus and the economy. Markets can be more a little bit disconnected from the actual economy. And the drivers of these scenarios are really, as we've talked about, the effectiveness and the degree to which sheltering in place is adopted and adhered to, that ripple effect on businesses, and in particular, in this case, the small businesses that are being so affected, the timing of the virus peak, the magnitude and the impact of government stimulation, and then the kind of the positive wild card is the potential advances in treatment, vaccines, and ventilator production. Treatments and vaccines, one benefit to the current environment is that science advancements is allowing for more rapid analysis and creation potentially of treatments and vaccines faster than ever before in the past, but still not clear how fast that can be done. So the investor discipline is, of course, another scenario driver. And the big message is that what's really waiting, the markets are really waiting for now, is some kind of positive news. And that's why it's likely to have some bouncing around for a while until there's more clarity about that. So what's next? Here's a potential good news scenario. It's just a matter of when. And that depends on how people respond in communities, as mentioned before, in terms of trying to tamp that down and flatten the curve. But such flattening of the curve would allow for appropriate hospital capacity and life-saving, as mentioned, to give more time to stretch out the virus impact, which would allow for more time for treatments and vaccines to be created, and government stimulus to have impact that decreases uncertainty, allows people to feel more comfortable spending. The panic investors may rush back in, as sometimes they have in the past. And so those are elements that are likely to happen. It's just a matter of when, depending on these drivers we've talked about. And we think that most likely the worst impact of the market is behind us. It may be bouncy for a while. It may go down further, but the bulk of the worst part of it, or the real worst part of it, is very likely already happened. So being disciplined to get that full recovery is really critical. And a few other elements that are relevant for all scenarios. Immunity will increase. That's part of what helps shape that, flatten the curve over time, and time helps with that as well. Rebalancing is, for those that are wondering, hey, I'm nervous about markets, or how do we take advantage of that? Well, rebalancing will systematically do that. It's uncomfortable, but that's effective in the long run. So there's a nice quote here from Warren Buffett that may be helpful as well. So those that are disciplined, those that stick with it and that have a strategy that has already accounted for this type of drop in the long run should be remain on track for the long run. So key message we'll always bring back to you is that to focus on what really matters and the things that you can control, and what that means in general from a financial planning and investment strategy standpoint is to have and stick with your plan, your goals, save and spend wisely, have appropriate investment strategies for life stage or for strategic need, of course diversification, and then discipline and rebalancing through those dips. So we want to thank you for your time. This is a quote here that we think may be a good mantra for everyone as we go through what will almost certainly be some continued bumps for a while. Thank you for attending, and I'll take a look and see if there are any questions that come in that we can address. Again, thank you.